You buy a stock, the screen says about $100 a share, and you don't hesitate. The trade fills instantly. But at that exact moment, if you wanted to sell it straight back, you get less than you just paid. Not because the price dropped, it hasn't moved a cent. You've just run into the most overlooked cost in trading, and it isn't a commission or any fee your broker lists. It's hidden inside the price itself, because the price you were looking at was never really one number. It was two, and the gap between them just cost you. Here's what a single price is actually hiding. At any moment, a market holds two live prices at once. The first is the bid, the highest price anyone is willing to pay for the stock at this instant. The second is the ask, sometimes called the offer, the lowest price anyone will sell it for. Buyers sit on one side with their bid, sellers sit on the other with their ask. On our ladder, the best bid is $100 even, and the best ask sits just 5 cents higher, at $105. That about 100 you saw on the screen is just a headline. The two prices you can actually trade at are the bid and the ask. And the real market lives in the gap between them. That gap has a name, the bid-ask spread. It's simply the ask minus the bid, what sellers want, minus what buyers offer. 105 on the ask, 100 even on the bid, subtract one from the other, and the whole difference is 5 cents. On a busy stock that looks like a rounding error, but it's a real cost, waiting in the price every time you trade. So watch what it does the moment you actually trade. There's one rule about the spread that quietly decides the cost. Here's the catch: as a rule, you don't get the good side of the gap. Buy now and you pay the higher ask, sell now and you take the lower bid. To get in, you reach up the 5 cents to 105. To get out, you come back down to 100 flat. Every time you cross the market to trade immediately, you cross that gap. The only way to skip it is to not trade right now, to post your own price and wait for someone to come to you. So put the two together, and the hidden cost appears. Buy 1,000 shares at the ask, then a second later sell them straight back at the bid, a full round trip in and out. The price on the screen never moved, but you paid the 5-cent gap on every share just to go in and come back out. 5 cents a share sounds like nothing, but do it on 1,000 shares, 5 cents, 1,000 times, and that's $50. $50 gone on a trade that went absolutely nowhere. And an active trader runs this round trip hundreds of times over, so the toll quietly stacks up. It never shows up as a fee, and it sits on top of any commission or tax your market already charges. So where did that 5 cents actually go? It went to whoever was on the other side of both your trades. Very often, that's a market maker, a firm whose whole job is to always be ready to trade. They quote both prices at the same time. They'll buy from you at the bid and sell to you at the ask. When you bought, they sold to you at 105. When you sold, they bought from you at 100 even. They took both sides, and on a normal trade, they keep the 5-cent gap in the middle. But they don't keep that whole gap every time. Sometimes the person trading with them knows something they don't, bad news about to break, and the maker gets caught on the wrong side and takes a loss. On average, the gap is their pay. On any single trade, it might not be. So it isn't a trick, and it isn't hidden, it's their pay for a service. But pay for what exactly? Think of the currency kiosk at an airport. It's always open, and it will always trade with you this second, but it buys a little low and sells a little high. That gap is what you pay for not having to wait. The market maker is exactly that kiosk, but for stocks. There's a word for it, immediacy, and the spread is its toll. You didn't lose that 5 cents a share, that $50, you spent it on speed. The alternative was to post your own price and wait, maybe for hours, maybe forever, for someone else to want your exact trade at your exact price. The maker takes on real risk standing there always ready, and sometimes trading with someone who knows more than they do. And the spread is what pays them for both, on average, which means the size of that toll isn't random. So if the spread is the toll for now, why is it almost nothing on some stocks and brutal on others? It comes down to one thing: How many people are competing to trade? On a giant, heavily traded stock, many market makers fight to post the best price, and to win your trade, each has to quote a tighter gap than the last. That crowd of ready buyers and sellers is what traders call liquidity, and it's what squeezes the two prices together, down toward a single cent. But take that crowd away, and the toll doesn't just grow, it explodes. But now watch what happens to a stock almost nobody is trading. This is where that tiny toll turns into a painful chunk of your money. Swap our $100 ladder for a small one, near $10 a share. The bid sits at $9.50 and the ask jumps to $10, a 50-cent gap. On the $100 stock, that 5-cent gap was a tiny sliver of the price, small enough to ignore. But a 50-cent gap on a $10 stock is a huge bite out of the same money. As a share of what you put in, that toll is 100 times bigger, even though nothing changed but the price tag. That's why traders measure spreads as a percent of the price, not in cents, and the ladder shows you exactly why. And the gap doesn't just sit still. It rips wide open when trading dries up, when prices swing wildly, and hardest of all, right around news. An earnings report, a rate decision, a surprise headline. The spread can blow out in seconds, so trading straight into news is exactly when the toll bites worst. It widens too when your own order is so big it chews straight through the best price. Thin, nervous, rushed, or right into news, the toll goes up, and that's the moment to slow down. And because that toll is printed right there in the quote, the spread quietly tells you something before you ever click buy. Getting in always feels easy. A maker will happily sell you into even a thin, widespread stock in a heartbeat. The door in is always open, but that same wide gap is the price tag on the door out, already printed in the quote before you commit. A 5% spread means the moment you're filled, you're 5% down, and you'd have to claw that back just to break even. So a wide spread isn't only a cost, it's the market warning you in advance how expensive the exit will be. Read it that way, and the spread stops being a fee and becomes a warning label you can see before you commit. Here's what puts the choice back in your hands. You are not forced to pay the toll. Send a market order and you cross the spread on purpose. You're the taker, you pay for speed, and you're filled right now. Or send a limit order. You name the exact price you'll accept and simply wait. Now you're the patient side, playing the exact role the market maker did. You post your bid and wait. And if someone in a hurry to sell crosses down to your price, they pay the gap to get out now. So your filled limit order captures a piece of the spread instead of handing it over. The catch is real. Waiting means you might not get filled at all, and the trade can leave without you. One honest footnote, even as a taker, you're sometimes filled a hair better than the quote, so treat the spread as the baseline cost, not a fixed tax. But the choice itself never changes. Pay the toll for now, or wait for your price. So the next time you see a single price on a screen, remember what it's hiding. There are always two prices, a bid and an ask, and the gap between them is the spread. That spread is the toll you pay to trade right now, instead of waiting. It's the one idea worth keeping. A price isn't a signal telling you what to do, it's a test of how badly you want now. See it, and you'll never read a quote the same way again. Next, we follow the spread into its sneakier cousin, slippage. Not the gap you can see, but the worst price you actually get when the market moves or your order's too big. And it's ugliest right around news. And tell us, which corner of the market should we pull apart next? This was Chartimals reading the market, one ladder at a time, educational, never advice.